Greetings of the day. My name is Vaibhav Singh, and today we will be diving into the topic of initial public offerings, exploring their significance, process, and impact on companies and investors. So, what exactly is a IPO? An initial public offering (IPO) is a process through which a privately held company offers its shares to the public for the first time, allowing individuals and institutions investors to purchase ownership stakes in the company. It is a significant milestone for a company as it transforms from being privately owned to becoming a publicly traded entity. So, the eligibility conditions to launch an IPO in India. The company type. The company must be registered as a public limited company under the Companies Act 2013 or either applicable laws. It can be an existing unlisted company or a fresh issue of shares by a new company. The second point being track record. The company must have a track record of at least 3 years in terms of its operations, profitability, and net worth. However, this requirement may be relaxed for certain sections or companies under specific circumstances. The third point being financials. Companies should have audited financial statements for at least 3 years with a minimum net worth as prescribed by SEBI. The financial statements should comply with Indian Accounting Standards (IND-AS) or Generally Accepted Accounting Principles, that is GAAP. The fourth point being minimum issue size. The company should meet the minimum issue size requirement as prescribed by SEBI. This is the minimum amount of shares to be offered to the public. Promoter contribution. The promoters of the company are required to contribute a minimum percentage of the post-issue capital. The exact percentage is determined by SEBI and may vary based on different factors. The sixth point being SEBI approval. The company must obtain the approval of SEBI for the IPO. This involves filing a draft over different documents known as the Red Herring Prospectus (RHP) with SEBI, which is reviewed and approved by SEBI before IPO can be processed. Points about the Red Herring Prospectus are preliminary documents. The RHP is called the prospectus because it contains all the necessary information about the company and the IPO, but excludes certain key details such as the prices at which the prospectus will be offered to the public. These missing details are included in the final prospectus after the company receives approval from the SEBI. The second point being the key information. The RHP provides comprehensive information about the company, its businesses, financials, promoters, management, risk factors, and the purpose of the IPO. It also includes details about the objects of the issue, the proposed utilization of funds, and the terms of the offer. The third point is draft filing. The RHP is filed with SEBI for its review and approval before the company can proceed with the IPO. SEBI examines the RHP to ensure that it complies with all the relevant regulations, disclosure requirements, and investor protection norms. The fourth point is market and investor education. The RHP is used for marketing and investor education purposes during the potential investor can study the documents to gain insights into the company and make informed decisions. However, they cannot place any order for shares until the final prospectus is filled. Uh, the fifth point being book building process. In the case of book building IPO, where the process of the shares is discovered through the bidding process, the RHP includes a price range within which investors can submit their bids. The final price is determined based on the demand generated through the bidding process. The sixth and the last point being final prospectus. After receiving approval from SEBI, the company publishes a final prospectus which incorporates a offer price and other final details. This document is circulated to the public and investors can take into applications for share in the IPO. Points under book building process during IPO are price discovery. The main objective of the book building process is to determine the optimal price at which the company can issue its shares to the public. The issuer, along with the lead managers, decide a price range within which investors can submit their bids. Then is bidding period. The company announces the IPO and offers a bidding period during which investors can place their bids. The bidding period typically lasts for a few days. The third point is investor categories. The book building process caters to two categories of investors: qualified institutional buyers. These include institutional investors such as mutual funds, insurance companies, banks, and foreign institutional investors. And the second one being retail individual investors. These are the individual investors who are not qualified, classified as QIBs. They can participate in the book building process with a smaller bid lot size compared to QIBs. The fourth point is bidding method. Investors submit their bids specifying the quality of shares they wish to purchase and the price they are willing to pay within the price range specified by the issuer. The bids can be revised during the bidding period. The fifth point is demand aggregation. The lead managers collect and compile all the bids received from investors. They maintain a book that records the demand for shares at different price levels. The book is characterized into different investor categories such as QIBs and RLLs. Price determination. Based on the bids received and the demand aggregated in the book, the issuer, the lead managers analyze the demand at various price levels. They determine the final price at which the shares will be issued to the public, which is typically set at the price that generates the highest demand. The seventh point being allotment and refunds. Once the price is determined, the shares are allocated to successful bidders. In case of oversubscription, where demand exceeds the number of shares available, allotment may be scaled down proportionately. Refunds are issued to unsuccessful bidders. Number 8 point being listing. After the shares are allotted, the company lists all its shares on the stock exchanges and trading commences. Investors who have been allotted shares can sell or hold shares based on their investment objectives. Important guidelines regarding IPOs in India. Regulatory authority in India, IPOs are regulated by the Securities and Exchange Board of India (SEBI), which is the primary regulatory body overseeing security markets in the country. The second is eligibility criteria. SEBI has established specific eligibility criteria for companies seeking to go public. These criteria include factors such as the company financial performance, track record, minimum issue size, and the compliance with disclosure requirements. The third is disclosure and prospectus. Companies planning an IPO must prepare a comprehensive disclosure document called the prospectus. The prospectus contains essential information about the company, its business operations, financials, risk factors, use of proceeds, and other relevant details. SEBI mandates that the prospectus provides accurate, complete, and material information to help investors make informed investment decisions. The fourth point is book building process. In certain cases, IPOs in India may follow the book building process. It involves the company and the underwriters determining a price range for all the shares and investors, indicating the quantitative and price at which they are willing to subscribe to the shares. The fifth point being the lock-in period. SEBI imposes a lock-in period on the shares held by promoters, pre-IPO investors, and certain other categories of shareholders. This lock-in period restricts these shareholders from selling their shares for a specific duration after IPOs, which is typically 3 years. The sixth point is listing and post-IPO compliance. After a successful IPO, the company shares are listed on the stock market for trading. The company must comply with ongoing disclosure requirements, periodic financial reporting, and other obligations stipulated by the stock exchanges and SEBI. Compliance with these regulations ensure transparency and investor confidence in the company. How to prepare financial statements before launching IPO? So the first step being engage professional assistance. It is advisable for startups to engage professional accountants, auditors, and financial advisors like IPO experience to ensure accurate and compliant financial statements. These professionals can guide the company through the complex process and help meet regulatory requirements. The second point being select applicable accounting standards. Determine the accounting standards to be followed for preparing financial statement. In India, GAAP or Indian Accounting Standards IAS may apply depending on the size and nature of the company. Third point is historical financial statements. Prepare historical financial statements for a specified period, usually 3 to 5 years, depending on the regulatory compliance. These statements include the balance sheet, the income statement, the profit and loss account, and cash flows. The fourth is audited financial statements. Get the financial statements audited by a qualified independent auditor. Auditing ensures the reliability and credibility of the financial information provided. The auditors will review the financial statements, access the company's internal control, and issue an audit report. The fifth point is compliance with regulatory requirements. Adherence to the regulatory requirements of the market in which the IPO will be launched in India. SEBI prescribes certain guidelines. The specific format for financial statements, disclosure, and reporting requirements. Then is pro forma financial information. In addition to the historical financial statement, prepare a pro forma financial information. Pro forma statements present the company's financial position and results of the operation as if particular event such as an acquisition or a merger has had occupied earlier. Number seven is key financial metrics and KPIs. Identify and calculate key financial metrics and KPIs that are relevant to your industry and business model. Number eight being management discussion and analysis. Prepare a comprehensive management discussion analysis section that accompanies the financial statement. This results of operations, liquidity, and future prospectus. This could include a narrative explanation of financial performance, risk, opportunities, and other factors that may impact the company. Number ninth being disclosures and footnotes. Include relevant disclosures and footnotes to the financial statement. These disclosures provide additional details about accounting policies, significant accounting estimates, contingencies, related party transactions, and any other material information and investors need to take informed decision. The 10th point being internal controls and governance. That is, establish robust internal controls and governance mechanisms to ensure the accuracy and reliability of financial reporting. This includes implementing accounting systems, segregation of duties, periodic financial reviews, and compliance monitoring. Then is professional organizations to launch IPO. The first one being SEBI. The SEBI is a primary regulatory body overseeing the securities market in India. It regulates and supervises IPO, ensuring compliance with relevant laws and regulations. SEBI plays a crucial role in setting guidelines and providing necessary approvals for IPO, protecting the interests of investors and maintaining market integrity. The second point being BSE, that is Bombay Stock Exchange, is one of the leading stock exchanges in India and operates the BSE SME exchanges, a dedicated platform to small and medium enterprises SMEs to list their shares and raise capital. BSE aids startups throughout the IPO process, including eligibility, evaluation, listing requirements, and compliance with regulatory guidelines. The third point being National Stock Exchange (NSE) is another major stock exchange in India. It operates the NSE emerge platform which focuses on listing SMEs. Uh, NSE provides support and guidelines to support startups seeking to launch an IPO, facilitating the listing process of ensuring compliance with regulatory norms. Fourth is Institution of Company Secretaries of India. ICSI is a premier professional organization for company secretaries of India. Company secretaries play a crucial role in the IPO process, ensuring compliance with regulatory requirements, drafting and filing necessary documents, and facilitating communication between the company and regulatory authorities. ICSI offers guidelines and resources to startup and their company secretaries throughout the IPO journey. The fifth point being Institute of Chartered Accountants of India (ICAI) is a statutory body responsible for regulating the profession of chartered accountants in India. Chartered accountants play a crucial role in the IPO process, conducting audits, preparing financial statements, and ensuring compliance with accounting and auditing standards. The sixth point being the merchant banks and financial advisors. Merchant banks and financial advisors often affiliated with financial institutions and investments banks play a significant role in assisting startups with IPOs. The Steps to be followed for launching IPOs in India. First one being eligibility and preparation. Ensure that your company meets the eligibility criteria set by the Securities and Exchange Board of India (SEBI). Conduct thorough internal assessment of your company financials, operations, and governance structure. Prepare audited financial statements, prospectus, and other necessary documents. Appoint intermediaries. Engage intermediaries. Include investment bankers, underwriters, legal advisors, and registrars to be issued. The third is due diligence. Conduct a comprehensive due diligence process, including legal, financial, and business due diligence. The fourth is draft prospectus. Prepare a draft red herring prospectus (DRHP), which provides detailed information about the company, its business, finances, risk factors, and IP offerings. The fifth point is SEBI approval. SEBI reviews the DRHP and provides the observations and certifications. Once SEBI is satisfied, it issues the final observation letter allowing the company to proceed with the IPO. Next point being marketing and roadshows. Engage in marketing activities to create awareness and generate investor interest. Conduct roadshows to showcase the company's strengths, prospects, and investment potential to institutional and retail investors. Price determination. Collaborate with investment bankers to determine the issue price based on the market conditions, demand, and the company valuation. Decide the size of the offering, include the number of shares to be issued and the portion allocated to different investor categories. The eighth point being IPO allotment. Open the IPO subscription period, allowing investors to apply for shares, allocate shares based on subscription received and SEBI regulation. Funds are issued to unsuccessful applicants. Listing. Obtain final approval from stock exchanges for IPO listing. Issue shares and credit them to investors' demat account. The 10th point being post IPO compliance. Fulfill post listing requirements such as periodic financial reporting, corporate governance, compliance, and regulatory disclosure. Maintain transparency and adherence to SEBI regulations regarding shareholders, communication, and investor relations. So the recent startup IPOs, that is Zomato, Nykaa, Policy Bazaar, Paytm, Cartrade, Nazara Technologies, and Map My India have launched their IPOs in 2021. So thank you so much for listening to my presentation.